Hello, and welcome to the last episode of Signal and Noise for 2024. It's great to have you with us. At the start of this year, we taped an episode of this program entitled, Can the Goldilocks Market Continue? At the time, there were many reasons to believe that this rally wouldn't keep going. But let's look at what's actually happened in the last 11 months or so. The ASX 200 is up 10.5%, the S&P 500 up a even more remarkable 27%. Bonds have sold off on the benchmark, but a lot of that move has happened after the US election. Corporate bond values have appreciated. The Australian dollar has been weaker, but that's again, a lot of that is a strong US dollar story. And gold and Bitcoin, as you can see, they're really the stars of 2024. So, what have we learned from the last 12 months, and where might markets go in 2025? Well, it's time to find out and bring in the last Signal or Noise panel of the season. We've got a first-timer with us. Simon Clark is an equity strategist at Morgan Stanley Wealth Management. Welcome to you, Simon.
Yeah, it's good to be here.
We are delighted to welcome back to Signal or Noise for the first time in a couple of years, Stephen Miller, Investment Strategy Advisor at GSFM.
Great to be here.
And also sitting on the investment committee of QIC, right, Steve?
Yes.
The Queensland Sovereign Wealth Fund, so good to have you as well. And making her 25th appearance on this program. Frankly, we wouldn't do this show without her. I think there'd be a protest if you ever left. Diana Mousina, AMP Deputy Chief Economist and our series regular. Let's get straight to it. One huge thing that has happened in the month that we didn't do a show was the return of Donald John Trump to the White House. We are already starting to see some of the early policies be implemented, especially around tariffs, with 10% being placed on China, additional tariffs, and 25% being placed on Mexico and Canada. In other personnel news, hedge fund manager Scott Bessent has been tapped on the shoulder to become the Treasury Secretary, a move which Wall Street seemed to like. And following Trump's election win, this is how different sectors of the US market moved. And I'll note here that the data was compiled by Goldman Sachs and BetaShares. And as you can see, their financials really the outperformer. They're up 6% in the wake of the election. A lot of that move is because financials were one of the star sectors the first time around. The first 4 years of the Trump presidency. So, panel, and we'll start with you, Diana, as I always do. I'm wondering if you could tell us about a signal, and in this case, it's an investment idea that benefits from Trump's re-election, and one noise that is the investment idea likely to be a loser under a second Trump administration.
So I think for a signal, I'd say US equities, at least in the short term. And the key reason for that is, I think, because markets are still rallying on this news that Trump's likely to put through his deregulation plans, tax cuts for individuals and for corporates. And I think that markets generally like that environment. But you have to be mindful that next year we're going to get more volatility because we're going to get higher tariffs announced. We don't know how long they're going to go on for. Other countries are going to retaliate just like they did in 2018. So it's hard to see markets moving up at the same pace that they did this year, next year. So in the longer term, it's a bit of noise for US equities, but at least in the next few months, I think that there can be more upside.
Okay, that's interesting. So US equities provides both a signal and a noise. It just depends on your time frame.
Yeah, because I think this euphoria around Trump is not going to last forever because ultimately we are going to get higher tariffs. And also next year we have to be mindful that the US is going to implement tighter immigration controls and try to deport people. They're talking about deporting 500,000 people a year. And that is a negative for GDP growth, a negative for employment and the US labour market, which relies heavily on immigration flows. And I think that US economic growth next year is going to look softer. It's running at 3% on an annualised basis at the moment. It's very hard for that same pace of growth to continue.
Okay, thank you, Deanna. Stephen, do you know one signal, sir, the investment idea that benefits, and one noise, the investment idea that's a loser?
Yeah, I sort of agree with Diana. I mean, I can see why US equities rally, but I think she raises a good point. If this trade war is serious, and global trade wars are internecine, one of the losers will be global equity markets. I think that's true, particularly in the EU, maybe Mexico, maybe some selected emerging markets. So I'm tempted to say US equities conditionally. I think more so though, and it's a bit more of the same, I think Bitcoin unambiguously, just because of the lighter regulatory touch, and somewhat controversially and maybe counterintuitively, I think gold. And now that might look funny because bond yields are probably going to be higher. And there's sort of question marks about global growth and what have you. US dollars appreciated. I'll tell you why I think gold, because when I've done my noise, and that's bonds. And for an old bond manager, that makes me a little bit sad. And the reason I say that is three things. One is the US budget deficit. The second thing, as Diana mentioned, tariffs. That's unambiguously bad, at least in the short term for US inflation. There's question marks about the longer term. The third is the prospect of a politically pliant Fed. I think that might make short-term rates lower, long-term rates higher, so a steeper curve. But I think it also means that there's sort of some nascent concerns on inflation and inflation expectations. And the other reason for bonds, and this is a bit left field, if the US engages in a trade war with China, how many US treasuries do you think China will be buying? And so, you know, so bonds is one I don't like.
Interesting. Thank you, sir. Simon, one signal from you, sir, please, and one noise.
Sure. Well, we agree on the US market perspective. So we think a big factor of the Trump Republican government incoming is deregulation. Deregulation is really good for markets for a number of reasons, but we think it's particularly good for financials and US banks. And the reason we say that is that we're coming out of a very long extended period of very tough regulations for banks. So banks have had to rein in balance sheets, they've had to rein in lending practices. So we're going from that kind of environment to deregulation. So it's quite a big pivot, a change of direction, and we think a turning point for US banks. So deregulation has a number of benefits for the banking system, but one big one is it frees up a lot of balance sheet capital. They can return that to shareholders, they can reinvest it, and it also frees up capital markets activity, so expect more M&A, which is also good for the banks. But I think a big reason is too, the banks are very cheap in the US. And so to give you an idea on bank valuations, to buy a mega cap US company, you're paying north of 30 times price to earnings multiple. And you can buy a JP Morgan or a Bank of America on 13 to 14 times.
Okay, so the banks are the signal, and have you got a noise, an investment idea that might be a loser under this?
So we're less positive around the election on consumer discretionary stocks. Okay. So we think with tariffs coming in, I think that creates a lot of adjustment for the sector. So some of the effects will be rising input costs. It creates questions around prices, around consumer affordability. So some adjustment there. The other big factor is that a lot of these global retailers and brands have big exposure to China, material exposure to China. And we see, as a result of tariffs, weaker demand out of China. So we're less positive on consumer discretionary.
Thank you, sir. One result of Trump's return to the White House is the reintroduction and a huge spike in tariffs against China. Mind you, Beijing already responded to the first set of tariff proposals, saying no one will win a trade war or a tariff war. Analysts say these tariffs, if implemented to the full, and of course there's a lot of question marks around that, will cause the Chinese government to implement even bigger stimulus. Nomura analysts say they're likely to be closer to 3% of GDP, while the Economist intelligence unit says the size of the package could be as much as 20% larger. And regardless of whether these tariffs are fully implemented or not, it appears investors have already made up their mind. Take a look at this chart. Chinese government data reveals that foreign investment in the world's second largest economy, well and truly running for the exits. Through September 2024, almost $13 billion has left the country. So, panel and Steve, I'm going to go to you to start this round. Are the announced measures, so far at least, enough to get investors putting money back into Chinese or China proxy assets again? Or is it all not enough? Signal or noise, Steve?
I'm highly sceptical that it's enough. I sort of think that macro policy in China is almost pushing on a string. I think Lucy Ellis put it well the other day in a forum where she said that the Chinese economy is just not configured to recover from these things. It's not configured to push along domestic demand. A lot of these measures are designed to pump up manufacturing and pump up exports. And in an environment where lots of other places are pumping up manufacturing and doing it cheaper, like Vietnam, China is going to struggle. And while it pumps up exports during a trade war, that's problematic. What it should be doing is focusing on domestic demand. It's a signal that outflow of foreign investment or net outflow of foreign investment is a signal and it's likely to continue.
Simon, to you now. Is it enough or is it not enough? Signal or noise?
So we would go with noise for now on that as well. We ultimately think that China is going to fall short on providing enough stimulus that we think they need to reflate the economy. So to give you an idea, we think they need around 10 trillion renminbi over the next couple of years to re-stimulate the economy. We think they're going to do around 3. So they're falling very, very well short of that. In the meantime, we think tariffs are going to take effect. So for now, we actually see further earnings downside for Chinese companies. So we're staying on the sideline there for Chinese equities. We've got an underweight rating.
That's fair enough. Thank you, sir. Deanna, which way are you going to go on this, signal or noise?
3 times charm, and I'll say noise as well.
Sure.
And really the key reason is sort of similar to the other comments, but to some extent, China's equity market is so reliant on policy announcements, and there's a lot of exuberance or expectation around the policy announcements, but oftentimes the actual announcements don't actually meet the expectations. And that's what we've seen in the last few months. They have said that they want to do more in saying that, especially in the first 3 months of next year. So I think we are likely to get some more consumer-driven stimulus measures, because the basic problem is that consumer spending is so soft because property investment is still down 20% year on year, home prices are down 20 or 30%, and people save via the housing market. So we really need to get home prices back up to get people more confident about the outlook for housing. So I do think we are going to get some stimulus announcements. And let's also not forget that the Chinese economy is still growing by 5% year on year. Contrast that with Australia, where we just had the latest GDP data that showed sub 1% annual GDP growth. So it's still a massive economy. There's still plenty of areas for upside growth in manufacturing, fixed asset investment, industrial production. But the consumer is struggling, and from an investment point of view, it's just too unreliable.
Yeah, no, absolutely. Thank you. It's time to move on to a tradition of the Signal or Noise end of year show, and that's what we call the big call. We ask each member of the panel to bring along a prediction they have for markets for next year. Everyone gets 60 seconds to explain their prediction and their case, and then I ask the rest of the panel whether they agree or disagree. Simon, we get to start this with you. You get to be on the soapbox first. What is your big call for 2025, please, sir?
Well, so for us, it's actually luxury travel stocks. So this is based on a report we posted last week that was titled Airlines, the New Luxury Good. So just up front, this is also general advice. But if we look at one of the big things that's happened in 2024 is that share markets around the world have all hit all-time highs. So what we think that also means, and also typically means, is that household wealth is also growing. So the affluent consumer, wealthy households are basically getting wealthier, and their consumer purchasing power continues to increase. And what we've also found is that these wealthy households and consumers are tending more and more to spend more of their budget on experiences and services like travel, more so than spending on watches and handbags. So we actually have clients owning stocks like Delta Airlines. We also own Qantas, and a global Morgan Stanley top pick is actually Accor Group, which is an owner of some of the big luxury hotel chains like Raffles and Fairmont.
Okay, thank you very much, sir. Deanna, wrestle with that one. Do you agree with Simon's big call? Is that a signal, or is it noise if you disagree?
Yeah, I think it's a signal. The bottom-up sort of analysis around that absolutely makes sense. And I think the outlook for consumers in general is more optimistic over the next year relative to the past 2 years. We're seeing better wages growth. The unemployment rate might increase a little bit, but for the top end of households that hold the top 5% that hold the majority of that wealth, an increase in the unemployment rate is probably not too much bad news for them. And interest rates are going to come down. Again, that might not be so much of an issue for some of those top-end households, but I think the general outlook for consumers is more positive.
Okay, thank you very much. Steve, what about you? Signal or noise? You agree or disagree?
Well, I've got to say my immediate experience would be to say that's a signal, because if my family is any judge, and given their expectations as to how much their parents should fund their holiday, I think it might be a very, very strong signal. So, from a personal perspective...
Are they asking business class flights everywhere?
Well, they asked. They don't get, but they asked. So from a personal perspective, I can see that. I mean, I guess what I worry about with that call is just, and maybe I'm overemphasising it, but as I said in my earlier piece, global trade wars are internecine things, and they affect global economic activity. And I just fear that if global economic activity takes a hit, that, and it's certainly not just luxury travel, but lots of enterprises will struggle, but among them may be luxury travel. And again, that's not to say I'm in violent disagreement, nor am I in violent agreement. It's just that I'd put a question mark over that call for that reason.
Okay, so can we say signal with a caveat?
Yeah, let's say signal with a caveat.
Let's say signal with a caveat. I like the way you think. Thanks, sir. Deanna, your turn. Your big call for 2025, please.
I'm going to say Goldilocks for 2025 you mentioned that word at the beginning of today's session, and it's really a view for markets and the economy, I guess. It's hard to see a big rebound in growth. I think that economic growth is still going to be similar to levels that it was this year, a little bit higher in Australia, a little bit softer in the US, but you're not going to see a big collapse. We think a recession is a low probability. At the same time, we think a massive reacceleration in growth is also a low probability because you still have some constraints on the economy, especially in places like the US, where we already spoke about some of those constraints. Central banks are likely to be slow to cut interest rates, or a slow cutting cycle. Inflation's coming down quite moderately, but that's not a bad scenario for share markets. It's hard to see the same return for US equities or even for Australian equities next year as we had this year. More, medium-term forecasts for a share market should be somewhere close to 7 or 8% next year. But in general, a Goldilocks environment is not really too bad for a diversified type of fund.
Very quickly, you talked to Q3 GDP earlier. How does Q3 GDP play into the nuance of that big call? Obviously, 0.3% quarter on quarter is not crash hot.
0.8% year on year, continued slowest growth in annual GDP that we've had outside of the pandemic since the early 90s. Doesn't really change much for the RBA. It was a tad softer than they were expecting, but it probably doesn't push them to cut rates in the near term, not in December. February is still a possibility, I think, depending on the quarterly inflation data in January. I think it is going to look pretty low, but I just don't know if it's going to be enough for them because of their rhetoric recently that they want to see more sustained lower inflation. I think that they probably should be cutting in February, but I'm not on the board.
Okay. Well, no, you're not on the board. You're here. Steve, I get to direct this to you. Is it going to be a Goldilocks year next year, signal or noise?
I'm tempted to say noise, but not with any great degree of conviction.
Sure.
Because at the moment, the momentum is very much with the Goldilocks scenario. The US economy is growing quite strongly. Inflation's a bit sticky, but it's not inconsistent with the 2 steps forward, 1 step back, last mile issues that Chairman Powell has canvassed in the past. So why am I sort of uneasy in embracing it as a signal? And again, it goes back to, and I'll canvass this a little bit later too, it goes back to my concern about bond yields. And it's, as I say, it's this quadrella. I can see a scenario where bond yields escalate sharply from here to the extent, and I agree with everything that's been said about momentum, about deregulation, about corporate tax cuts, all of that. I think that's all fair. I just wonder if bond yields will get to a stage where they become an overarching headwind on equity performance, and it sort of upsets that Goldilocks scenario. So I'm not saying it's not a credible scenario.
Yep.
It's just not one that's sort of front and centre for me.
All right, we'll come back to that in his big call in a moment. Simon, where do you fall on this, signal or noise?
Yeah, we would certainly agree with that Goldilocks scenario. So we think the environment's generally conducive for equity markets. So we have 7 or 8% gain in the US share market in the next 12 months and some small gains in Australia, for example. But generally the conditions are there. We've got deregulation, which is a big one that we mentioned already. Lower interest rates. We think there's more cuts to come. So yes, we think some of the Trump policies will be inflationary, but we then expect a demand response to that. So we generally think the disinflation narrative remains, which is good for markets. So all those factors are there. But I think what's also going on behind the scenes and what has also been a big driver of markets, and this is one thing not to underestimate, is the pace of innovation. And we think innovation's been a big theme for us during 2024. Most notable part of that is artificial intelligence. That's been a big one, but we've also seen innovation in other industries like healthcare, the financial sector. We've seen a lot of innovation there, and we think that's been a part of why equity markets have done so well. So we can't underestimate that going forward.
Okay, thank you, sir. Steve, you have already alluded to this big call a little bit. Tell us about your big call for 2025.
I'd prefer to say the big fear.
Okay.
Right? And as I say, if bond yields get high enough, and I can see a scenario where they do, I sort of think that, and I'm not contesting, the innovation, the momentum, the deregulation, all of those things are fine. I would question whether a large part of that's in the price. And I think what's not in the price is the prospect of higher bond yields and the consequences of an ongoing budget deficit. Having said that, I think the other thing, which should be part of this big call, is what Donald Trump says and what Donald Trump does are often quite different. He will be a mercurial president, you know. So I could be wrong on that. We could be wrong on tariffs. We could, you know, Elon Musk might wave a magic wand and take trillions of dollars out of the US government. And people like me that sit around wringing their hands, worrying about higher bond yields, will probably end up with egg on their face, if I can mix metaphors in that way. But, you know, in terms of something to worry about for 2025, that's the thing I worry about.
Okay. Simon, when you think about bond yields, I guess in your role, it's more so how it influences valuations, I assume, and things like that. But a call for sharply higher bond yields next year, what do you fall on that, signal or noise?
So we'd go with noise on that. So we do agree that there will be some inflationary impacts, again, from some of Trump's policies. So that will be first and foremost what happens. But then we think there's going to be a demand response following that. So inflation then levels out, and we get enough room and enough disinflation effects to allow for some rate cuts. So we've got 4 rate cuts by around mid next year still to come in the US. So again, that's supportive for markets. As I said before, there's a lot of other forces driving equity markets, and it'll be really interesting to see where artificial intelligence takes company earnings, I think, in 2025.
All right, thank you, sir. Deanna, what do you make of this?
I sort of understand where Steve is coming from in that concern, but our view is that bond yields are going to go lower next year. Okay. So I'm going to say noise as well, and really I guess it's premised on the idea of bond yields usually peaking when the central banks start cutting rates. So it stems from that. And the concern about budget deficits is definitely a big risk for next year. But I also feel like they're trying to counter that with the government efficiency, Elon, Vivek Ramaswamy appointments. And I also don't think that Trump will be able to pass as many policies to get the budget deficit higher as he actually can, because he doesn't have 60 seats in the Senate, which means that he needs to go through this process called budget reconciliation if he actually wants to pass all those policies that he's talking about.
It's time for our final segment. We have tasked the panel to bring along what they think or what they thought would be their chart of the year, something they've seen this year that they think tells a fascinating story about financial markets. Deanna, let's come to you. You picked a simple chart that actually quite tells the story. What are we looking at?
So I've indexed US and Australian share markets, S&P 500 and ASX 200 to January 2024, which basically just shows you the massive outperformance in the US share market. So US shares are up by about 26% year to date, Australia's up by 11%. That doesn't include any dividends. So when you account for dividends, Australia does look a bit better because we normally do pay higher dividends. And of course, if you account for franking, that's sort of a separate issue, but that's not really what the purpose of this is. I think it's just meant to demonstrate this massive outperformance that the US share market has had. It also, to me, points to the fact that valuations do look very stretched. This continued outperformance is very difficult to replicate. A lot of that has been driven by tech. The tech sector has had earnings growth of over 10% year on year, and that is likely to slow next year. So I think the performance gap between the two is going to narrow in the new year.
Okay, thank you very much. Steve, you've picked a subject that economists and bond managers love having a debate over, the US fiscal deficit. What does this chart say?
Yeah, old Mr. Glass half empty again. Look, I've sort of outlined my fear scenario, but what are the consequences of that chart? So the consequences of this, I'm not sure that things like the old 60 portfolio are going to be that efficient anymore. I think the assumption that bond returns and equity returns are always negatively correlated, which actually they're not if you look back in history. They were for the first couple of decades of this century, but that was an unusual time, more so than a time of normality, if I can put it that way. So if that's the case, what should we be looking at as an alternative? And it gets back to this the first principle of investing. Diversify. And how do you diversify? Well, you diversify away from equity beta and bond beta. I'm not saying they shouldn't be the foundations of your portfolio, but if you think a 60-40 portfolio is going to do the job, I think you want to think again. So I think you should be looking at something like a 50-25-25 portfolio. So what's this 25? Well, I'd call that things that are uncorrelated, as I said, to equity or bond beta. What might that be? Long short, whether it's long short bonds or long short equities. It could be quant or macro hedge funds. It could be gold, which relates back to my earlier point about, gold being certainly, I think, a safe harbour alternative to bonds, given the fears I have. And it could be, for those that are adventurous, and I stress for those that are adventurous, a little bit of an exposure to Bitcoin. And can I say, I've lost my virginity on Bitcoin, and the experience hasn't been too bad so far. But I'm not that adventurous. I am a bond guy after all, and I've only got a very, very tiny bit of my self-managed super fund in Bitcoin.
The bond man mentioned he bought Bitcoin, everybody. Write this down. Simon, you, sir, get the last word of the entire season. What's your chart, and what does the market? What does it say in your view?
So I'd say this is certainly a glass half full chart. So this shows the growth in return on equity, key measure for profitability in the US, matched over time against valuations. So when we look at an individual company, what we typically find is that companies with high return on equity also tend to attract high valuations. So we think the same can actually be said for a share market. So in the US, we've seen far better, that chart showing that we've seen far better return on equity results from that market relative to the rest of the world over time. And the market's actually liked that and been willing to pay it, willing to pay for it. So we actually think that that is recognition and justification of the valuations in the US market that we see at the moment. And then going forward from there, as in terms of the outlook, that's another factor we think can also drive, support markets going forward, is that we think there's more room for that ROE to go forward. We mentioned US banks. Deregulation can help return on equity. Financials and banks are a big sector in the US. Artificial intelligence, one of the prime objectives for corporates is to get that to improve their profitability, their margins, and ultimately their return on equity. So that ultimately sits behind the background for us in terms of a market driver.
And that, my friends, is Signal or Noise for the year. For the last time this year, let me thank the panel. To Stephen Miller of GSFM, thank you very much. Simon Clark of Morgan Stanley, thank you very much. And of course, to Diana Mousina of AMP, thank you all very much for joining us. Because it's the last show of the year, I want to quickly say some thank yous, if you'll indulge me for a few seconds, please. To the team at Livewire, and in particular Eddie, Jess, and the content team, thank you for another wonderful year. I really appreciate everything you do. To Liz, who puts together the graphics for this show and makes the thing look $1 million, thank you very much. And especially Izzy, a videographer and editor, who puts up with all of my ideas and antics for this program. Obviously, to all the guests we've hosted this year, thank you very much for all your insights and your energy. And most importantly, to you, our audience. We wouldn't be here, wherever here is, without you. Have a great Christmas and New Year, and we'll see you when we see you. Bye-bye.